Hey, everybody, welcome to another episode of the Alternative Investor Mastermind. I'm your host, Jack Krupey, and today we're going to talk about how we find and how we evaluate alternative investment opportunities. I'm going to focus more heavily on the real estate syndication space just because that's the highest volume, but I will give a few examples of some other asset classes and how we came across them, and how we made some decisions to make some investment allocations. So the first way that we've identified deals is through existing relationships. Having been in real estate over 20 years, developed a pretty significant Rolodex and done business across single family, multifamily, non-performing mortgages, and built up quite a database of contacts. So there's really no substitute for time and just long-term establishment of testing and vetting out relationships. For example, 4 of the projects that the current JCAM fund is involved with is with a group where the key principal I've known for close to 15 years. And also did business with him in the mortgage business, but he had been a real estate developer and operator of multifamily prior and moved into the non-performing mortgage business. We did some business there. Then as the business is adapted, we actually went back and now are following his lead into these multifamily projects. So that's a great example. And a number of examples, are just people I've, known for a long period of time, or close business partners or colleagues have known for a long period of time. The second way is through mastermind groups. These are groups of like-minded professionals that, often have significant membership fees, and that leads to a pretty exclusive group of investors that, can afford to be a part of these groups and that are, taking the business seriously and are, successful investors. So really a different level than, say, going to, an airport seminar or just a weekly or monthly meet group, that has a lot more newbies coming in, and certainly some experienced people, but, just the cost, and often these are destination events, the travel does really limit it to, more sophisticated, serious, full-time investors. And in those groups, many of the groups we would invest with have also had other investors in the group invest with. So we've got immediate vetting through current investors who've already had success working with these operating partners. So mastermind groups are great. Industry conferences are great as well. There's a number of conferences we attend every year, and often there's 500 to 1,000 attendees, and it's a combination of expert speakers, sponsors, and both deal sponsors that just walk around the venue, and actual those that are getting booths to have a direct place to advertise their track record and their services, as well as a lot of limited partners and just passive investors go to these conferences as well to look for opportunities and to meet with the many of the sponsors they already invest with. So those are 3 ways that we generally came across our partners, and majority of the deal flow we've invested with on the real estate side. On some other alternatives, being based here in Puerto Rico, it's a mastermind of its own to some extent. There's thousands of us who've moved in the last few years, and many of us have interesting and niche business opportunities. So one of the areas that I'm likely to do a separate standalone show on in the future is actually syndicating convertible loans to public companies, or companies that are pre-IPO going public. This is generally done through a convertible note, and we actually convert our investment at a discount to the IPO price. So we're out at the IPO regardless of what the price is, and generally a 30% plus discount to the IPO price. And on top of that, we get warrants. So for the next 3 years, we have the ability to exercise the warrant for additional profits on these deals. So the overall returns have been tremendous. And, it's a real, really interesting small niche that, I've only found because of just being in a community of interesting and successful investors. So I want to talk a bit about vetting. vetting multifamily deals, there's a lot that goes into it. You can get super, super complicated, but there's really a few key components that we tend to on any individual multifamily deal. We want to look at what is the cash on cash return, what is the loan to value, what is the going in cap rate, the entry cap rate, and what is the value add strategy. The really key component, especially in an era where cap rates are historically low, sub 5% in many cases, in some cases even sub 4% in very, very hot markets. The key to the overall strategy is, can you increase rents? Can you renovate apartments and reset rents to a $400 to $500 or more higher amount? And or are the current rents truly below market where on renewal you'll be able to increase rents without renovation? And what is that number? If those numbers are right, that is probably the most important part of the deal, because those are the numbers that you can control. And if you get those numbers right, you're part of the way there. Other things we take into consideration are, what are the current interest rates? What are the interest rates likely to be in a few years? That we never know, but there's an ability to build in a sensitivity analysis and look at what does the deal look like in 3 years at a 4.5% rate, or a 5 or a 6% rate. And what does that do to the cash flow? What does that do to the ultimate value of the building? And we do the same thing on the cap rate on a sale. And that number, where you set that number, affects what appreciation in the value of the building will be, along with what value did you raise the rents to, how much did you increase the net operating income. So, those are key components. Currently, given some of the market conditions, we've actually been looking at deals that have slightly lower leverage. And because of the lower leverage, in some cases, there's a slightly higher initial cash on cash return, which we like. However, the overall return, the overall IRR on a percentage basis may be slightly lower, just because we're using less leverage and we're just being more conservative with our numbers. So we have to put more equity into the deal. So there's potentially a slightly lower IRR, or which loosely matches an annual return, average annual return. But the IRR is just much more detailed, and you have to run it in Excel versus just sort of looking at a cash on cash, or looking at your total dollars, dividing it by the amount of years. So, where we are in the market right now, who knows where things go long term. I don't foresee a 1980s style interest rate rise over into the double digits, but I do think for the next year we may see continued rising rates, and we're coming into an election cycle as well. So who knows what happens overall. I do think rates will be higher than they were over the last year or two, but my gut is they'll stabilize around where they are right now. If there's a hiccup or another economic type issue, the Fed would likely lower rates again the next time there's a real emergency or catastrophe. So the moment there's real issues, there'll probably be another stimulus or another lowering of rates, or the Fed buying bonds again. So I think the government's proven over and over again that they will step in and pump money into the system, if and when they need it. So we're cautiously optimistic about the economy, and I've said this a number of times, but we really, really agree with the dollar cost averaging principle, and that's part of my overall investment philosophy, is to be diversified across multiple assets and multiple markets with multiple sponsors. And if rates continue to go up, and or values even in some cases pull back a little bit, we're going to be continuing to invest into deals, and we'll invest on the way down as we invested on the way up. And over the course of 3 to 5 to 10 years, as long as each individual buy we make is well thought out with a strong value add plan, I think we're going to do just fine. And I think any investor who follows that path should do just fine. As far as asset classes, multifamily to me is still solid, and the best, if not one of the best asset classes. Self-storage is still tons of opportunity there. Self-storage and mobile home parks have pretty significant price increases over the last 5 or 10 years, but probably not as aggressively as multifamily. Some of that has to do with the financing. with Fannie Mae, Freddie Mac, and a number of the non-bank lenders like Arbor and ReadyCap, the financing for multifamily was extremely aggressive, probably the most aggressive. Mobile home and storage still had more traditional financing, slightly lower loan to values. So we hadn't seen the same level of run-up in prices on those asset classes in general. And, there's still a substantial housing shortage. So as far as focusing on new construction, whether it's ground up multifamily, ground up build to rent, ground up industrial, personally involved in a ground up industrial deal, and the JCAM fund is involved. We made an allocation to a light industrial newer construction building in Lakeland, Florida. Real interesting value add situation. It was new construction, and the builder sold it with only one tenant in place that has about 60% of the square footage. So they sold it at a pretty reasonable discount because we need to wait probably 3 months to a year to lease up the other part of the space. And at that point, the building will cash flow extremely well. And we'll capture the discount that we received on acquisition. And once it's leased and stabilized, it'll be a great cash. So we were pretty well compensated for probably taking 6 months of risk on leasing up the property. And we're also our first fund is in a ground up senior living community in Iowa that we like a lot. Returns are expected to be close to 30% IRR in that deal. So as with construction, you're trading off no current cash flow for pretty large upside on the back end. And risk-wise, although there's no cash flow, if you're confident that there's a reputable builder and the sponsors you're working with, have all the funding in place, which is typically required. If there's a bank with a construction loan in place, typically all the equity for whatever the 20 or 30%, of equity for the construction loan is typically upfront, whether the land was already purchased cash and is contributed, or all of the rest of the money needed for the equity portion of capital has to be raised and in the bank so that the bank will then fund the entire construction loan process. So feel pretty good about those deals. And I think, as long as price of materials pencils out and the project can be built for a price that's still a discount to the final market value, I think, new construction will continue to be a strong asset class. So that's it for today. I encourage you all to subscribe and leave a review. Please also check out our YouTube channel for those who like to watch video. And this is an audio-only version, but many of our podcasts are also video. And subscribe. Those who want to follow along with what our fund is doing, subscribe at jcaminvestments.com. We have a mailing list for new users, and we also do put out some our active opportunities to invest alongside us in deals for those that are interested. So thanks again, and look forward to doing the next, having you on the next show. Thanks, everyone.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.